Hi guys, welcome to Grow Worlds. Today we'll be looking at Chevron. Before we start, I would like to ask whether you've seen our video on MTN. In case you missed it, I'll be adding a link to the video so that you can watch it after this. Please do not forget to comment, ask your questions, like and share this video. Also subscribe to the channel so that it will be updated as soon as new episodes come out. Let's get started. For some of you that don't know, Chevron is a multinational company. They're in over 10 countries, American-based company, and they've been around for over 100 years. So the question would be, is Chevron a good investment? But before we do that, we first of all want to look at the business. How is Chevron doing? And then we'll now try and value Chevron and see if the price is currently trading is a good deal for us. Let's get to the numbers. So revenue. If we look at the graph here, see that the revenue has been going down. This is not good because we want to see revenue going up, showing that Chevron has been declining. Also, sales growth, not surprisingly, has also been going down. This is not good enough. Now, I tried to dig deeper into what's the reason for declining revenue. So Chevron divided its operation into two, the upstream and the downstream. Basically, upstream is all about prospecting for oil and drilling oil, while refining and distribution of refined products and downstream. If you look here, you see that both the earnings is also going down. So these earnings are the operating income. That's if you removed all the costs. Also, revenues from upstream and downstream, though it's not here, it's also going down. So basically, it's not just a segment issue. All of Chevron's earning capacity is going down. So let's look at margins. If you look at net income margin is also going down, showing that Chevron is not doing well in terms of revenue, also in terms of cost, and also not doing well. Although gross profit has remained relatively flat. Now let's look at returns. How well has Chevron been able to make returns for investors? So it's not surprising that return on equity is going down. It has to go down because of when you're not making enough money and also you're not managing your costs, it's impossible to make returns. So we can see the southward trajectory both in return on equity and also earning per share. So if you look at also see that net income margin, everything is going down apart from financial leverage. Now I went deeper to look at financial leverage for Chevron. So I noticed that Chevron issued a large amount of debt last year. So basically they did this to refinance old debt, and also because of the interest rate was low. So that made that kind of gave them an advantage. Just issue new loans to use it to pay off old and expensive loans. If you look here, also that debt to equity is also going up, which is not necessarily good. Now let's look at cash flow. So cash flow margin ratio is just trying to tell us for every $100 that Chevron makes, how much are they able to keep as cash. Notice that this is also going down. Currently it's about 11%, which is not that great. We want to see it going up. Then also cash flow coverage ratio is trying to say that the cash generates, how much can we use it to pay interest. If you look here, you notice that it's going up. It's going up because remember I mentioned that Chevron refinanced some of its old loans that were expensive last year. So that's why this ratio is going up. Now investments. Basically, someone we ask us now that oil prices are like going up. Does it make sense? Will the share price Chevron do well? Yes, of course they are in a position to do well, but how well would you do? So I looked at investments. If you are familiar with oil and gas sector, it is that for you to start producing oil in a green field, it may take like about 5 to 7 years. Green field is like, let's say you discover oil in your backyard. Before you can drill 1 barrel of oil, it's going to take like 5 years to 7 years. If you look at, notice that Chevron, their capital investment has been going down. Basically, even if oil price keeps going up, they are not well positioned to take advantage of this, because if you are if you are reducing your capital investment, where are you now going to where would the oil come from for you to sell? So basically, we looked at the revenue numbers, not great. We looked at the margins, that's the cost, not great. We looked at debt. This kind of fair because Chevron has been able to refinance expensive loans with cheaper loan, although the amount of debt they are carrying is quite higher than what it used to be. Then cash flow is fair because Chevron generates cash. About 11% of their revenue they retain it as cash. Now try to value Chevron. Basically, these were the assumptions. I assume the 2% growth rate for Chevron. This is a bit fair because over the past 4 years, their compounded annual growth rate has been 1%. So I did 2, 3, 4% for them. Then I did our price to earning ratio. Currently, the price to earning ratio is 22. So I did on 18, 25, 30. So ignore this price to cash flow ratio. I didn't use it because I wasn't really impressed with Chevron's performance, so that's why I didn't have to do it. But valuing with price to earning ratio, notice that the pessimistic value is $82, while the optimistic value is $140. Currently, Chevron is around $110 to $102, showing that they are fairly valued. So basically, I'm not seeing much of an opportunity in this company. That's all about Chevron. Please, I would like to get your feedback. Have any question on this? Maybe there's a company you want me to look at. Also, don't forget to like, share. And next video, I'll be telling you how you can retire with $1 million. Thank you. See you. Bye.